I just want to add again that just last week, I mean, whether respect to the taxation or not, we released, Shobhit and team released a note, debt funds time to accumulate. So irrespective of the taxation, it was already a time to invest in debt given the higher level of yields that are prevailing today as compared to what it was last year. So anyways, these are good times to invest in debt funds, and over and above this taxation changes has come. So these are the 4 days of big opportunities that we have. So we have categories like corporate bond fund, banking PSU, short term, medium term, credit risk, and the target maturity funds. All that we have. Briefly at the end, we'll also discuss about other categories like gold, silver, global funds also, which have also gotten impacted by this taxation change. We'll try and answer those questions if there are any questions, or we'll take them up. But I'm going to hand it over to Shobhit and request him to start with, to begin with, before even the market outlook. Would like to hear from you. At HDFC Mutual Funds, what are the philosophy we adopt? What are the processes that we have that makes us probably a go-to fund house when it comes to debt funds in the country? So over to you, Shobhit. I'll just, as requested by you, I'll try and bring those slides so that you can take it forward. Over to you, Shobhit. Are these slides visible?
Thank you, everyone, for joining in on this call today. As I understand, time available is not very much, so I will want to keep this webinar to the point, not too long. The first thing which I want to cover is how do we go about selecting a fund house, or how do we go about selecting a fund? So here I would start with my own personal experience. How do I invest, and how do I select a particular fund, or which fund house to invest in? So for the first thing I consider is the brand. To me, that is the starting point. And for me, HDFC has been the brand which represents solidity, the brand which represents trust over number of years, which they have demonstrated. And therefore, at least in my case, the choice is very easy and simple to make. Mutual fund. So brand is very important to begin with. The second aspect for selecting or going about selecting a fund, or the where to invest, is the investment philosophy. In our case, we have kept things very simple, and we have been talking about it in the past, that our philosophy of emphasizing safety, liquidity, and returns has been followed consistently, and has been followed in letter and spirit. It is not just something we just say and don't mean anything about it. We just put it on a PowerPoint presentation that this is our investment philosophy, and it sounds all very good. But when you get down to actual investing, you would find typically not everyone follows the philosophy they say, or they state that that is the investment philosophy. But at HDFC, at least, we are very conscious of each and every investment which we make. Safety is prioritized, at the top of the, order. Then comes liquidity, and then comes returns. So we have never chased returns. We don't believe in chasing returns. We have to look at how safe each and every investment that we make is, how liquid it is, and then look at what kind of returns we can earn. And over the years, if you look at how we have done, in our journey from, say, 2001 onwards, over 20 years, and you would see consistently we have followed the basic investment philosophy and have not compromised on it. The other thing which is very important for me is the investment process which the fund house follows. And here again, we have, over the years followed consistently a investment process which lays a big amount of emphasis on credit and how we go about selecting credit, how we use our, multi-dimensional credit process for the, benefit of each and every investment which we make. So it's not that, this thing has been just taken from somewhere and is being deployed and used. It is something which we have come up internally, which we have developed by experience. And over the years, we have figured out that in the Indian market, in the Indian conditions, what works and best to, perform in terms of the credit environment, in terms of your credit selection and credit results. So therefore, if you would have seen, we have our own credit scoring model. We use various parameters, come up with our own internal rating and outlook on each and every credit which we are going to take, and follow what we call the 4Cs of credit, which we consider, are extremely important. We collateral, which is there to pledge, the capacity to pay, character of management, and the governance. So all these things go into selecting a credit, ensuring that it performs well by monitoring how the credit is likely to do over the years, and then seeing the outcome and the results. Now, if you see the period from 2018 have been a tough phase for the industry. There has been post 2020 again another tough phase for the industry. So, in my view, the way I look at investing in products is to see how the fund house or the fund has done during tough times. In good times, everyone does well. But in tough times, if you can stand out and do well during the tough phase, I think that is what makes a big difference for me. And if now investors are going to allocate money for very long periods of time, right now what we are looking at is a time when investors would be allocating money for not just 1 or 2 years, but most people which we are interacting with are looking at allocating investments for very long periods of time, which could run from 5 years, 10 years, 15 years. So it is extremely important that investors focus on the brand, the philosophy, and the process which the fund house follows, and see their track record and how the funds have done during tough times. In good times, a lot of guys have performed well, a lot of fund houses have done well, but in tough phases, in tough market conditions, look at the track record. And this is where, we stand out. And ACFC, so our process, the strength of our investment process is what gives us conviction that, investors need to focus on these factors rather than considering returns. Even in the past, our fund returns may not have been one of the better ones. We may have been trailing, but it is the strength of our investment process. It's the strength and the quality of a credit process which has, demonstrated that in long periods of time, 10 years, 5 years, 15 years, it is that which matters far more than, where is your portfolio yield today? What is your return which we have been giving? So my humble submission is that do not focus on these factors. The factors which need to be looked at are the brand, what does it represent, solidity, trust, the philosophy, the process, and then decide where to invest. Now, moving on from this to where are we placed today on the interest rate cycle, I think, as we have been saying over the last several weeks and months, I think post budget, it was quite clear to us, given that the FY24 budget had come up with a lower fiscal deficit number. We have been of the view that this is the time to accumulate debt. Now, it is very clear that whether it is globally or whether it is in India, we are very close to the peak of the rate cycle. Even if, now in India, we do not expect a major rate cutting cycle, but given that growth could suffer, growth could see some degree of slowdown. There is a possibility in the next 1 to 2 years that there will be some rate cut by RBI. So we are at this stage in the high point or near the peak of the rate cycle. This is why we were quite convinced that this is the time to begin accumulating debt funds. And this was the case even before the changes on tax front. Now with these changes, this is an added benefit which one can lock in the next 4 working days. So from all points of view, I think given the flexibility which the funds offer, the ability to continue staying invested, the ability to defer your tax payout as long as you stay invested, all these advantages definitely, give investors these next 4 days to take advantage of this opportunity. And just the one last point which I want to touch upon is this debate, the entire debate which is happening in the industry on target maturity funds versus open-ended. And I think we are very clear, and I want to settle this debate as far as we are concerned, that at this stage, open-ended funds definitely score over target maturity. And why are we so convinced of that? Because interest rates move in cyclical manner, the flexibility which an open-ended fund has to modulate duration, to increase duration, in times when the view is good, and to bring down duration when, things are looking, as if not going favorable, that itself is a huge advantage. And I think target maturity products do not offer that. So in case over long periods, if the fund manager can capture maybe one or two right moves, say in 10-year cycle or 15-year periods, I think the added return which the fund would make would be there to be seen only in open-ended funds. In target maturity funds, one is stuck with that particular maturity, that particular duration, and there is hardly any flexibility to bring down duration or to increase duration from, if the view is positive. So from that point of view, it is far more restrictive. Open-ended products have far more flexibility. In the target maturity funds, if the targeted point on the yield curve is to be only invested in, it at times becomes suboptimal. If everybody starts chasing 2026 maturity in the market, obviously the prices will increase and yields will come down. So therefore, it becomes suboptimal to, go in for a particular maturity. The flexibility in an open-ended fund is that if on the point on the curve it is not looking that attractive, the fund manager can achieve that same duration, targeted duration, through some other manner, by doing a combination of longer maturity and keeping some cash, or longer maturity and some shorter maturity. You achieve the same objective. So the flexibility which is there in open-ended, the ability to modulate duration, I think clearly score over targeted funds or index funds. And I think at this stage, investors should clearly focus on open-ended funds. The what funds look good? To me, somebody allocating for really long periods of time where, investment horizon may not be as clear at this stage. I think products like short-term debt, corporate bond fund, long duration fund, I think all these funds give you a good option to consider at this stage, and get invested for periods as long as 5, 10, 15, or even longer. So with that, I'll stop here, and we can take questions or any other clarification which is needed. Thank you.
Thanks, Thanks, Shobhit. Thanks for being amply clear in terms of the overall outlook, and also making it clear in terms of the debate that happens in terms of whether to lock in with a TMF or to go for an open-ended fund. I mean, some of the open-ended funds that people could look into investing at this point in time is presented. For some reason, in this long duration fund is not there. I mean, for all practical purposes, assume that we also have long duration fund in this list as well. So now I will ask Shobhit you to briefly introduce or talk about each of these funds, maybe half a minute each, and also answer a question. What sort of horizon an investor should look forward to at this point in time? Because typically debt investors have a 3-year mindset. I mean, whatever. I mean, the long-term capital gains tax itself could have been the reason for that. Or typically in FDs also people look for kind of 3-year mentality, kind of 3-year mindset kind of comes into picture. At this moment, I mean, is it not a great time to, in fact, look at a longer time frame, because you will get the indexation benefit for a longer period of time? So that is one question. Also, you can talk about these funds individually as well.
Yeah, so see, I think if I had to just quickly go through the first three funds, which are there on the slide, I think short-term debt fund needs to be considered as an all-season product, right? And in fact, short-term debt and corporate bond. A corporate bond is 100% AAA, ideally suited for institutional clients who want 100% AAA only. So that is what it is. But short-term debt is more of a 75-25 or 75 to 80% AAA and 20-25 on the AA. Portfolio yield is quite good. But since as we know, interest rates move in cycles. Right now, the view is, rates can come down, but maybe 2-3 years from now, again, the cycle could turn and rates will start going up. So therefore, a short-term debt is a product which one can stay invested in this kind of a fund for a very long period of time, and this can be a part of your core portfolio. And this can be left in the portfolio for 5 years, 10 years, 15 years, and you would do well. So short and corporate could be part of your core. Now, on the other products, say like a banking PSU, medium-term debt, credit risk debt, are more, thematic in that sense. Medium and credit, of course, are tilted towards higher yielding assets with, larger allocation to AA. Portfolio yields are upwards of 8 quarter, 865, 70. So on these products, portfolio yields are very good, but allocation to these kind of products needs to be limited to, say, within a range of 10 to 30, depending on your overall individual risk profile. Banking PSU, again, a thematic fund. And as we said, a long duration needs to definitely come into play here, because we are looking at, investing for very long investment horizons. That captures long duration debt fund captures your investment into 30-year, say, government bond, 100% government oriented fund, which will be investing in the longest duration assets. So, that is something which can be again considered as part of your core portfolio. So with a mix of these, I think the targeted, whatever, in overall portfolio duration an investor is looking to achieve, I think that can be achieved quite well. So a lot of investors of late have been saying put in cash funds like liquid, overnight, ultra short, low duration. I think those are up to 1 year products, and keeping your overall duration sub 1 year would be suboptimal at this stage. So need to increase it with a mix of short-term debt fund, corporate bond fund, and maybe a long duration fund as the core of your portfolio, with some allocation to or maybe a medium term fund or a credit product.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.